Recently, I discovered that one of my colleagues, Sushmita, holds more than 15 life insurance policies, both individually and jointly with her spouse. Some were acquired independently, while others were suggested by agents, family, and friends. What's truly surprising is that the combined life insurance coverage of all these policies doesn't even amount to 50 lakh rupees. This shows how randomly they have bought the life insurance policies while they still remain underinsured. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. Now, to prevent you from falling into the same pitfalls as Sushmita, today we'll discuss the most common mistakes that you should avoid while buying life insurance. Let's start with the mistake made by Sushmita, buying wrong type of life insurance and buying too many policies. Imagine having 15 to 20 life insurance policies. Isn't it a mess to keep all of them active? And yet, when you come to know that the combined sum assured may not be sufficient to take care of the financial needs of your family members, what would be the use of having them then? When it comes to life insurance, there are various types, each with its advantages, but not all policies suit all. To make the right choice, you have to assess your insurance needs. Now, term insurance offers plain life insurance coverage at affordable prices, while other plans like endowment, whole life, money back, or ULIPs combine insurance and investments, which may be suitable for conservative investors seeking secure long-term returns along with some insurance. So instead of multiple policies, you must have at least one term insurance that provides ample life cover to pay for all your liabilities and provide for your family members in case something unfortunate happens. Now, if you don't have one, go to the ET Money app and get one right away. If you have any questions, you can even book a free consultation with the insurance experts who can guide you. Plus, if you are a conservative investor looking for secure investments, you may look at other type of insurance policies. Now, to know which life insurance is suitable for you, you may watch our other video, the right type of life insurance policy for you. The link is in the description. Now, if you are stuck with too many policies already, don't just shut them all. Let's look at the right way and correct time to exit a policy. How many of you know that when you buy a life insurance policy, the insurer allows you a 15 to 30 days time period to assess and review the policy document. Now, in this period, you can decide whether you want to keep the policy or not. This period is called the free look period. But if the free look period is over and you're not satisfied with the insurance policy, when should you exit? Does exiting make sense at all? Well, if we talk about unit-linked insurance plans, you usually pay the majority of the expenses in the initial 4 to 5 years of the policy. So if you have borne the majority of the costs of the insurance policy, it does not make sense for you to exit your policy, as it may result in you losing a chunk of money you have invested in. Or if you have only a few years left for maturity, it may be better to wait till maturity. Now, having said that, if you want to exit your policy after holding it for a few years, like 2 to 3 years, but have a long term, say 10 plus years before the policy matures, then you may consider surrendering the policy. But that too only after going through the exit terms, the surrender charges and surrender value. Not only that, if you decide to forego any of your existing life insurance policies, you will lose on the life insurance cover provided by these policies. So make sure to buy an ample life insurance before exiting your current policies. Now that we have spoken about the problem with acquiring numerous random policies, let's now explore the opposite scenario, where an individual struggles to make a decision about purchasing a life insurance policy. Some people keep delaying their purchase of life insurance, thinking that they are too young, too healthy, or too busy to buy it. However, this is a risky and costly approach. The longer you delay buying life insurance, the more expensive it becomes as the premium rates increase with age and health issues. For instance, for a 1 crore life insurance plan at age 25, you will have to pay just 9,000 rupees a year. That's a total of 2,70,000 rupees over 30 years. But if you wait until you are 35, the same plan will cost you 16,000 rupees a year, which adds up to 4,80,000 rupees. So buying insurance early can save you more than 2 lakh rupees in this case during the policy term. Now this happens because when you are younger and healthier, the insurance companies give you a better deal on your premiums and you get to keep those lower rates for the whole time you have the policy. Therefore, it is wise to buy life insurance as early as possible. Now, moving on, how big your life insurance cover should be. Most people don't know the correct figure and they end up being underinsured. Take the case of any XYZ person who had a life insurance policy, but the sum assured was not enough to cover his liabilities and family expenses. Now assume he passes away and his nominee has received the insurance money. But now the family is in a dilemma whether to pay off the liabilities with that money or save it for children's education. Such a hopeless situation, no? Now, to avoid this chaos, make sure you spend some time at the time of buying life insurance to figure out the right life cover. Your life insurance cover should be big enough to pay off all your liabilities like home loans and any other loans, plus provide for living expenses of your family and also cover the goals like your child's education and so on. And you can't afford to miss the impact of inflation, as with time, the cost of your goals is expected to rise. So, for instance, if you are saving for your child's higher education after 10 years, now currently the course costs around 20 lakh rupees. Considering an inflation rate of 7% every year, you would actually require 39 lakhs after 10 years for your child to pursue the same study. But if you are not into all the number crunching, here's a quick hack to find the right coverage. Add up all your outstanding debts, include 300 times your monthly expenses excluding loan payments. Add 3 times the current cost of your future financial goals. Now once you have got that sum, round it up to the nearest highest number. Remember, it's always better to have a bit of extra coverage than to be short when you need it. Next, let's look at another most common mistake which can result in the rejection of a life insurance claim. While not sharing your health condition or lifestyle such as smoking or consuming alcohol may reduce your premiums initially, it's important to think long term. If the policyholder dies due to an undisclosed health issue, the insurance company can deny the claim, causing problems for the family during a crisis. So think of it like this: lying about your medical condition or lifestyle habits may actually destroy the whole purpose of buying a life insurance policy. Saving a bit of money on premiums now doesn't help in the long run. It's better to be honest about your medical history, lifestyle, and other information to ensure your policy stays valid and your family is protected. This wraps up this video. If you found this information helpful, please hit the like button, share this video, and subscribe to our channel as well. We'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.